All right. Well, today we're going to talk about the real estate market. Jason Bott from Robertson Ryan is an expert in that space. So, Jason, why don't you tell us a little bit about yourself and how you got in this industry?
Yeah. Going way back to the beginning, I've always been self-employed, and I started off at the age of 20, starting a landscape business, and realized that was kind of a rough business to stay in. My wife's uncle was an insurance broker, and he was doing pretty well, and I decided to make that change, and that was about 20 years ago. So, and since then, I've morphed into becoming more of a specialized commercial insurance agent. And since 2014, we exclusively focus on real estate investors throughout the U.S. And that could be anywhere from somebody who's got their first duplex that they're buying, all the way up to people with a portfolio of 1,000 units.
Okay, so that sounds great. And as you know, Honeycomb, that's our space, apartment complexes and condo HOAs. So we do appreciate your expertise. Tell me, how do you think the industry has changed over the years? I've been doing this for a long time, 30 plus years. I'm aging myself now. In your opinion, how has this real estate market changed over the years?
Well, I'd say probably since I started to specialize in the space in 2015, you started to see a move of people investing outside of the state that they're domiciled in. So, a lot of East Coast, West Coast people were then couldn't afford anything on the coast, so they were then looking to buy more affordable properties in the Midwest, and that created a very large pool of out-of-state investors, which, prior to probably 10 years ago, it was almost just a non-factor. And as of right now, in most of these markets in the Midwest, they're some of the main buyers, and so you're getting a lot of competition from out-of-state investors who have more money against the local market. That's probably the biggest macro change we've seen over the years.
Jason, you were talking about how the market has changed. So I wanted to ask you, when you have your clients that are purchasing properties in other states that aren't domiciled where you're at, is it harder for you to find coverage for these properties?
It can be. I'd say, 5 years ago, it wasn't too much of an issue. But as that population of out-of-state investors has grown, underwriting is getting we're just seeing it actually this year at the end of 2022, where the underwriting is getting a little bit more stringent, where the underwriters are asking if people are out-of-state investors. So I'd say for that space, if you are an out-of-state investor, you just really got to make sure that you have strong property management in your corner. If you're going to invest in those out of market, in those metro markets that are outside of your domiciled state.
And I know you do have carriers that offer policies in different states, maybe not all of them. So I guess in your court, you just need the markets to place these properties in.
That's correct. And funny enough, we're in about 30 states, and I always say those are the states where you can buy properties that you can cash flow. The other states that we're not in, it's because the properties are so darn expensive, you can't buy them in cash flow. So we're not in those markets. Those more expensive markets, I have found over the years, are more of the markets where everybody's flipping properties, because that's where the opportunity is. The acquisition cost is just too high though for a long-term rental. 3 years ago, the short-term rental marketplace was not as big as it is now, and that's probably, besides the out-of-state investor market that I mentioned before, the short-term rental space. I want to say it grew tenfold in the last 4 years. I saw a stat from one of our insurance carriers that in 2016 there was about 20,000 short-term rental units, and now it's about 250,000 at the end of, I think that was at the end of 2021. So that's obviously another huge market. I'm not sure if that's going to keep growing. It's going to crash if we do head into a slight recession here in 2023. If all of a sudden, if they're going to be affected, but that's yet to come. So we'll see.
Yeah, it's ever changing, right? This industry.
It is.
So what about housing prices? They were soaring in 2022, and things are changing for 2023. How do you think that's going to unfold?
So, I think on these smaller properties, it seems to be a little bit more stable. In the last quarter here, and talking with a lot of other syndicators and other people who are looking at larger, complexes, anything that you do a commercial loan on, I think we're predicting about a 20% drop in pricing, and that's just reflective of the interest rates. Just because you cannot borrow money and still cash flow unless those rates go down. But people, on the smaller space and the 1 to 4 units, they can still seem to find those properties that are a little beaten up and still have an opportunity to do a value add and still turn it into a good cash flowing long-term rental or short-term rental. But so I'd say if I had to make a prediction, and again, I'm not a real estate agent, but just seeing the way that my clients are buying, it's slowed down in the last third of 2022 pretty severely. But we're just starting to see a pickup now here in mid-December of 2022. And I think there's going to be some activity next year, but it's still probably going to be a little subdued compared to the last 5 years.
Yeah, no, I think I agree with you there for sure. So pricing, insurance premiums, I think those are on the rise as well, considerably depending on the state where the property is at. What are your thoughts on that, and how are you dealing with your insureds with that discussion?
Yeah, so it's a discussion we're having about every 15 minutes here at the office. So I would say from 2015 to 2018, we had flat renewals for almost all of our clients. And it was very easy. Nobody even really had to shop their insurance. Everybody was happy that they were getting a little bump in rental income, and the insurance rates were flat. But then starting, I think it was in the last quarter of 18, we started to see the prices started to creep. And ever since then, we've had roughly 10 to 15% rate increases year over year. And the first year, not a problem, but you start compounding those rate increases and it starts to become pretty substantial. I mean, we've seen on some properties this year a 50% rate increase. And those are on probably Class C properties. So ones that the underwriters really are not comfortable with. Those are the ones that seen the largest. If it's more of an A, it's probably closer to maybe an 8 to 10% rate increase. And then going into 2023, hate to say it, but those rates are going to continue that 10 to 15% increase. All the weather-related issues we've had over the last 6 months have really beat up the reinsurance markets, and all the insurance carriers have to buy reinsurance, and they're going to have to pass that along to the rest of the marketplace. So you have that, you have inflation, and you still have construction costs are still up there. They still have not dipped down. Maybe they've flattened, but they're still up there. So do you have all those headwinds that you're fighting against? And I just don't see the insurance pricing, slowing down anytime soon. So unfortunately.
Yeah, no, I definitely agree there. So as far as your insureds and, their main concerns or issues they may have right now with insurance, would it be like insurance to value? We see the replacement cost estimators coming in a little bit high. So this is what the insurance companies are telling them to insure it at. So does that pose an issue for you when you're trying to sell these policies?
It does. I mean, it's a constant discussion that, hey, we just want to insure for the loan value, and if it's a single family property in Ohio that they bought for 3 years ago for $70,000, and it's now worth $150 with a replacement cost of $250, the insurance carriers are not not going to allow to insure it to $70. We're seeing a minimum replacement cost for most of the carriers at about $100 to $110 per square foot is the bottom dollar that they're willing to insure it. So if you have a 1,000 square foot building, they're willing to insure it to as low as $100,000 without losing replacement cost. But the other thing that people don't realize on the underwriting side is we can maybe insure lower, but the rates are going to be higher. So people can ask for it, but the underwriters actually debit for insuring and offering that less coverage. It's kind of an odd thing to think about, but that's the way the system is running right now. So it's a constant. I think, though it is improving, most people understand with, again, all those forces of increased construction costs, inflation, and everything else that they do need to insure their buildings, a little bit higher. So.
Okay. And then, as far as deductibles, 20 years ago, deductibles were pretty standard. They were pretty flat at maybe 1,000, 2,500. Do you see your insureds sharing in the risk and opting for larger deductibles?
Yeah, and I typically if it's a 1 to 4 unit building, I tell people that the $2,500 deductible is probably the sweet spot. If you're going to get $1,000 deductible, people don't realize they're usually not going to turn in a $2,000 claim and decide to get $1,000 back. They realize that will be not advantageous on their next renewal. They'll probably either get non-renewed and end up eating any of the savings that they had. The biggest one that we're seeing on on the smaller commercial side, so anything from 4, 8 to 12, is almost every insurance carrier is asking for that wind hail deductible, and they're really pushing for a percentage deductible. And many times a percentage deductible at 1 or 2% completely wipes out the cost it would be to replace the roof. You got a $1.5 million building and you got a 1% deductible. Well, it's $15,000, and people say, "Well, man, I can get the get the roof done for $20,000." It's like, yeah, I know that's kind of the point of the insurance carrier. Like, they don't want any risk on the roofs, especially in states like Oklahoma or Texas. I mean, especially Florida, they're pushing for a 2 or 3% deductible a lot of times, where they really have zero risk involved. So that's a struggle for a lot of smaller investors who are just taking their first step into the commercial space. They're making their first big purchase, and they're not realizing that they can't insure for that roof, the risk of that roof being shredded with a hailstorm or a strong windstorm. So that is a struggle. But again, for this coming year, especially with what happened in Florida, the insurance carriers are going to hold strong on a very high wind hail deductible, especially if the buildings are bigger. So that's going to continue. I think in the 1 to 4 space, you're going to still be able to get your $1,000 to $2,500 deductible, on a personal lines form policy. So that's what we're seeing so far.
Okay. All right. And then I guess advice. If you were to give one piece of advice to your real estate owners, what would that be?
From the insurance perspective, you want to make sure you're paired up with an insurance agent that has access to a lot of different insurance carriers and rating platforms that they can access to get as many options out there as possible. I think probably it's common knowledge in the insurance arena on our side of the table that, hey, you need your insurance contracts and access to insurance markets to get your best pricing. But on the investor side, especially when you're first starting out, you just don't realize that one agent could maybe only have 2 or 3 options, and the other agent could have maybe 25 options. And so just, if you're paired up with somebody who's just your normal home and auto agent, I would say you may want to take a look around and see if you can find somebody that's a little bit more, specialized a little bit more in the real estate space to kind of help you out to make sure you're getting your best options on the insurance side. So.
For sure. That's great advice, right? You want somebody to do their due diligence and really shop around for you and find you quality coverage at an affordable price.
Right. Yeah, without a doubt.
All right. Okay. And then lastly, I wanted to get your thoughts on this insuretech concept. We've had the standard industry or standard carriers in the real estate space for many, many years. And we have companies like Honeycomb, where we're insuretech, so we're using different ways of underwriting these risks. How do you think that's going to change the industry in the future? Or has it? Have you seen it already changing?
I see it starting to change in that it's speeding things up. Traditionally, when I got into the business 20 years ago, everything was paper applications, and we had to submit it, and it sat on the underwriter's desk. We had to wait for them to respond, and everybody's expectation was it took a little while, right? But as social media and everything else has come into our lives, I don't know anybody who's got patience anymore. And so everybody wants their quote, like as soon as they press the return button, they're expecting that quote to be there, and that's not going away. So I feel like whether you're the insurance carrier, insuretech, its speed to market is going to win most times. It really is, and insuretech's in a good position in that spot. I think the one thing in the background that I'm still seeing is a challenge is, there's still physical underwriters in the background, so there's still more work to do to make that process even faster. But it's definitely moving in the right direction. I mean, I like going onto the Honeycomb, platform and being able to put in the address, and it just pulls from the stratosphere all the information, and it kind of inputs it into the system, and it does save my team quite a bit of time rating up and getting that option in front of clients. So we're looking forward to continue to do. We love it, and hopefully it continues to keep moving forward and improving.
No, that's great. That's music to my ears because I do agree. It's ease of doing business, right? And if we can make this a streamlined process for you and your insureds, then it's a win-win for everyone.
Right, exactly.
All right. Well, listen, I really appreciate you taking time out of your day. I know time is money, so thanks for joining us today. And I'm wishing you all the success in 2023, and hopefully I'll hear from you soon.
Thank you, Laura. Thank you for having me, and wishing you success as well.
All right, great. We'll talk to you soon.
Sounds great. Take care.